we'll get going here right now. So just a quick little summary of what we're going to hit today. Talk a little about, mortgage rates, where they're going. Obviously, that's been a hot topic in the country with what's happened between 2020 and 2023. Pretty unprecedented in our history here. Credit cards, other unsecured debts, kind of where those are at, what you should be aware of. Fear versus solution. What should you do if you're in a particular situation? This is a hot topic. A lot of people want to hear about real estate investing. We'll spend some time on this. The 3 types of what you could do, and we'll get into the pros and cons and the do's and don'ts. The real estate market in general. A lot's been said. There's not a lot of inventory out there. We'll get into all that. And how to get one of these 3% mortgages in this market. All right. So we'll open up to any questions. Certainly what you guys can do is put questions in the chat box. Some of the stuff we can take on offline or reach back out to you once we're done here at the seminar. All right.
I'm laughing here because I see that caricature of you and I that was taken about 8 years ago, and now people see us live like that can't be them. They're so young and graceful, that caricature.
Yeah, no gray hair. Yeah. So a lot of kids will do that to you.
So the $1 million question: what can we expect with mortgage rates? It's no secret. Rates today are a lot higher than they were a year ago, much higher than they were 2 years ago. It happened so quickly. That's the biggest thing. All right. So last month, a couple of reports came out. 150,000 jobs were gained and added last month. They're expecting more like 180,000. Now, our opinion that when they are adding these jobs, I think a lot of people are taking second jobs because of where the prices are overall. But regardless, a statistic, it's down from where they expected it. Unemployment rate rose last month. It's the highest since January of 2022. So that, coupled with less jobs gained, people are not as employed as they'd like to be. Wage gains also slowed down last month. Now, it's a statistic. This mostly happened in the manufacturing sector, okay? But they look at overall numbers. So when the Federal Reserve sees these numbers, okay, we kept increasing interest rates to try and stop the inflation. That was when jobs were being gained more. That was when unemployment was going down. Wage gains were going up, albeit slow, but they were still going up at a higher pace than where they're currently at. So what happened last week? The Federal Reserve decided not to raise interest rates. Okay. So if anyone's around at 2 o'clock today, the most powerful man in the economy in the country will be speaking about interest rates and where, what their short-term plan is, or where they're kind of gauging where they're going to go. That's Jerome Powell. So he'll be speaking at 2 o'clock today. So shoot us an email after if you want to chat about it further. That'd be great. Here's our prediction. We think that interest rates on the mortgage side have plateaued. We think they're at their highest maybe a month ago to 2 months ago. In the past week or two, they've come down. They've come down because of what you see right there. The jobs, employment, wage gains, and really how much can the American people take? All right, so they've come down over the past couple of weeks. I think going into 2024, you're going to see things kind of level off going through the end of this year, beginning of 2024. They may go down a little bit. They may stay level where they're at right now. Now, what we do think, and this is kind of politics playing into reality here, is that we're into a big election year in 2024. At some point, something else is going to have to give. So we see interest rates for mortgages going down maybe a little bit more towards the end of next year. But, I think, Mike, you told me this expression once, maybe it's Warren Buffett that said, 50% of the world with this economy don't know what's going on. The other 50% don't realize that they don't know what's going on. Because all these charts the economists use, like inverted yields and whatnot, it's not making sense. But the trend that we see is that the worst is behind us in terms of interest rates, and it's greener pastures from there. When? We don't know. But that's mortgage rates. Let's get into the other interest rates and debts that are out there. Credit cards and other unsecured debts. Over $10,000 in credit card debt per household. Now, That may seem like a lot, that may seem like a little. In certain areas of the country, higher cost of living in the Northeast or somewhere, that number is higher, okay? The average interest rate on these credit cards is 24%. It should be against the law to have a 24% interest rate, but that's where we're at right now. It's a vicious cycle that we're looking at. Personal loans, like when you see Lending Club and things like that, those interest rates are over 21%. You have to see, you get some work done to the house, something bursts, like a pipe burst or something like that. You get that emergency card, or maybe you're getting these personal loans to pay off the higher interest rate credit cards. Yes, 21% is less than 24, but that's still a crazy number. Some car interest rates are over 11%. I'm seeing this at myself right now. My wife's looking to get a new car. If we got the same car 3 years ago, and we got a car 3 years ago, we got that same car today, the payment that we would be looking at is 20% higher today than it was 3 years ago. That's the inflation that we're all dealing with right now. We have a big fear with this. I think we're on the verge of a credit crisis. We see these credit cards that are taken out. We see credit reports all the time, and we're seeing more credit cards taken out in the recent couple of months or even in the past year. And the balances on those cards are so close to the limits that those cards hold. And people are borrowing upon borrowing. Now, I don't like to use these big numbers that, X amount is the debt crisis of America, but there's over $1 trillion in credit card debt in the country. Over $1 trillion. We've never been that high. And it's all because of the cost of living and everything just being more expensive. And I think that, unfortunately, it's going to take a toll on, obviously, your finances, but it's going to take a toll on your credit because, at some point people are borrowing from Peter to pay Paul, and at some point that's going to have to stop. And that's where the real problems arise.
Absolutely. So, Brian talked a little bit about the fear there of what's going on. Now, how do we talk about some solutions here? All right. 2020, 2021, mortgage rates were at the lowest in our nation's history. So, but most homeowners, if they were able to refinance during that period of time, some people were unable to because maybe their job is on hold during COVID or something like that. But there's a lot of people out there with interest rates around 3%. Now, they've racked up credit cards, as Brian spoke about, inflation, everything like that. So you have these massive monthly payments with all these different credit cards, but you don't want to refinance because you don't want to give up that 3% interest rate. Now, the domino effect of that. All of a sudden, you have this high interest credit card debt. You go out, you take personal loans. Your monthly nut on all of these payments is really, you're forced to go paycheck to paycheck. You start falling behind on bills. Or maybe you max out your credit cards, you just pay the interest, or you miss payments. All of these things will end up reducing your credit score. What a lot of people don't realize, if you have a credit card, that you're allowed to charge $10,000 on it, and you maintain a balance of $5,000 or more on a month-to-month basis, more than 50% of what you're allowed, it eats away at your credit score. Obviously, taking on more debt also lowers your credit score. All of these things that factor in. Now, if you're playing a prevent defense here and you're just trying to get by, you're going to end up in over your head, and you're going to continue, as Brian said, borrow from Peter to pay Paul. All right. The solution. Here's some different options that we have here at Fellowship Home Loans. Debt consolidation, cash out, refinance. All right. So here's a similar situation that we just did for somebody recently. All right. Here are their current debts. They had a mortgage, $275,000, original balance $350,000, with a 3.75% interest rate. The principal and interest payment on that is $1,620. We consolidated a Capital One credit card, $9,500 balance. The minimum monthly payment, and why I specify minimum there, is because you're only paying the interest. So if you pay that $223 every month, the $9,500 does not change. Home Depot. The store charge cards typically have the highest interest rates. It was a $16,000 balance. I believe the person's got some new windows or something like that. The monthly payment was $625. Finance car with $30,000 balance on it. Payment was $650 a month. Bank of America, $10,000 balance with a $275 minimum monthly payment. All right. All of this ended up to $3,393 a month, 1620, and all of these minimums right here. We consolidated all of this with a new mortgage payment at 7%, also gave the person $15,000 cash in hand, and they saved nearly, cash in hand 15,000, and they saved nearly $1,000 a month on their total monthly obligations. As we always like to say here, when someone's buying a house, you shouldn't let mortgage payments mortgage rates scare you from purchasing the house, because you're going to date the rate, you're going to marry the house. So in this case, $33.93 was not sustainable to pay a month for this homeowner. They were drowning in this debt. So what we did was consolidate it all. At 7% is not a great interest rate, but mortgage rates are cyclical. When that comes back down, we'll refinance that and get the interest rate reduced and the monthly payment reduced. So it's a real win-win there, and got this particular homeowner out of a really, really crummy situation that they were in. All right, we want to talk a little bit about real estate investing. Most of the people that signed up this seminar, this seemed to be the hot ticket item. All right, you have three types of real estate investing that you can do. A fix and flip. We all say, hey, let's buy a fixer upper. Buy that house, put some money into it, and sell it for a profit. Pretty simple, something that people have been doing for years. Long-term rentals. Buy a house, rent it out, make sure that the rent at least covers or exceeds what your total household obligations are on it. It's also a good idea with long-term rentals to look into multifamily houses, 2, 3, 4 family. All right. And then you have your short-term rentals, Airbnb, stuff like that. We all know what that is. Probably all stayed in Airbnb at some point as well. There are different types of mortgages for these products. All right. We have investor loans, which is called like a DSCR loan, where you don't have to show any income. What we do is we show that the rental that you can obtain on this particular property will pay for the mortgage with the taxes and the insurance included. And we have some other types of investor products, construction loans, things like that. I could spend hours talking about all the nuances of them. So that would be something that we would take offline if you want to hear more about those. Now, things to consider. On the fix and flip, don't outkick the market. All right. You don't want to, if you're in a moderate income area that you're doing a fix and flip, you don't want to go with marble countertops and a Viking range stove and all those types of things, because you're not going to get your money back on that. All right. If you're in a higher income area where someone that's buying something like that is going to expect those things, then you have to factor that in. Always, contractors tend to go over budget. If anybody's ever done work to their house, I know I have, I know Brian has, you got to plan for that. It's going to end up costing a little bit more than what they say. There'll be some things that happen. All of a sudden, we ripped open the wall. We discovered another problem. Okay. And the things add up a little bit too. In addition to that, you most likely will use a real estate agent to sell the property. So, it could be 3-4% added on. So if you're selling a property, you do the math on it, that eats away at your profitability right there. Search on future value before committing. So something that we can do here at Fellowship Home Loans is say, all right, well, we know we can pull comparable sales in the area. You bought this property for $300,000. You're going to put $100,000 into it. Based on a fully renovated, 2,000 square foot house in this particular area, you should be able to sell that for $600,000. All right, that's $200,000 that you have there. But you got to factor in your carrying costs. If it takes 6 months to do the construction, what's your mortgage payment during that time? What are the taxes? What are the insurance? And the real estate agent as well. All of those things come in and they'll factor into what your profitability is going to be. All right. Long-term and short-term rentals. Be aware of HOA fees. All right. If the property is in an association, how much are the HOA fees, and what do you actually get for that? Property taxes play a huge role in profits on long-term and short-term rentals. And what I mean by that, we're here on Long Island, Nassau County. We have some of the highest property taxes in the country here. All right. So our mortgage payment, when you look at the principal, interest, taxes, and insurance, is a much bigger number. In many cases, the taxes per month are more than the actual mortgage itself. All right. On Long Island here, a lot of people do long-term and short-term rentals out of state. Okay. They'll go into the Poconos. They'll go into the mountains in Tennessee, areas of Ohio, things like that, because the taxes are a fraction of what they are here. So their overall monthly nut is significantly less, so they can make a lot more money on it. In addition to that, do you have multiple seasons? So if I said by a show of hands, who here likes to go sit out in the mountains where there's snow on the ground, go skiing, things like that, that's their ideal vacation. Probably half of you would raise your hand, and the other half would say, no, get me on a lake or a beach and put a pina colada in my hand or something like that. That's what's going to be more enticing to you. But if you have a property like you do in the Poconos or different areas that is appealing in the summer as well as the winter, you're going to get top dollar in both seasons. Last thing on that is use a management company for these long-term and short-term rentals. You know, or out here on Long Island, it could be 3 hours to get to the Poconos. We don't want to get a phone call while we're busy at work or doing something with our kids at the sink. Doesn't work. All right, there's companies that do this. They handle dropping the keys off, picking the keys back up, getting the house clean, getting it presentable to the next person, and they take a moderate fee. In addition to that, if you're vetting houses, these management companies can let you know what these particular properties will fetch on a long-term and short-term Airbnb type of a rental.
This is the idea behind this one is passive income. Passive income is the best income. Again, you don't want to get those phone calls. You want to be as hands off as possible. Make sure that check comes in every month, it clears, and you live your life and not have to worry about what's going on at your rental property.
All right, and let's talk a little bit about the real estate market here, Brian.
So the question is, why are prices still so high when mortgage rates are where they are? Okay, simple. It's supply and demand, right? A lot of people are not moving right now. A lot of people aren't moving because they have a lower interest rate. So they're going to they have a $500,000 mortgage and at 4%, and they know that if they sell to even get a bigger home or something equal or something along those lines, they're going to get a higher interest rate right now. So they have the house that people want. A lot of people are still looking to buy homes, but there's not a lot of homes out there. We speak to realtors on a day in, day out basis, and they're hurting too. And they're saying the inventory is just not there. So what happens when rates go down, like we're saying they're going to in the future, and inventory goes up? What's going to happen to home values? I think that they're going to go, I think the prices are going to come down. It's not going to be a crash. It's not like 2008, right? We're not looking at all of a sudden overnight people are losing, $100,000 in equity in their home. And we're not looking at builders going bankrupt, not looking at vacant properties all over the place because builders just stopped building because there weren't the buyers anymore. All right. This has a lot to do with a different way of lending that we're doing right now. In 2008, let's face it, the market crashed because if you had a pulse and you can sign your name, you had a good chance of getting a mortgage. The vetting process wasn't there. The employment verification wasn't there. You didn't have to you go 100% financing because, okay, the market's going to keep going up. That's not the case anymore. The checks and balances and lenders that are doing responsible lending are doing their job and making sure that people are going to pay their mortgage. Foreclosures in 2008 skyrocketed. It went out of control. And that's obviously went to the crash. That's went to values going down so much because you had, in a 3-block radius, you had 4 homes that were in foreclosure, bringing your value down. All right. That's not the case right now. You're looking at a pretty healthy market, and you're going to have an adjustment. All right. There's going to be an adjustment in prices. Just like any type of market, it's cyclical. All right. The value of your home, it should go up a little bit and then maybe come down a little bit. Come up a little bit, come down a little bit. But overall, you're going to see a steady rise in terms of the value that you have in your home. That's why purchasing a home is still a wise investment, whether it's for investing purposes or for your own personal use, owner-occupied homes. Right? If you look over a 10-year span, just like the stock market, you see big, in a month span, you see the market go down, the market go up. But if you look long-term, it's a steady rise. And that's why real estate is a very solid investment, because you're going to have something to fall back on, and you're making money while, obviously making aggressive income or just steady, getting more equity in your home. This was a popular one that a lot of people wanted to talk about. All right, how do you get a 3% mortgage in this market? Mike just had a slide up, and it said that in his example, that interest rates were 7%. So how do you get a 3% mortgage in this market? It's called an assumable mortgage. All right, this has to happen on a purchase. So FHA loans, VA loans, USDA loans, those are assumable mortgages. So if you're looking to purchase your home, you purchase a home, if the person that you're buying from has an FHA loan or a VA loan or a USDA loan, you can take over that mortgage. A lot of people that may be selling their home these days or in the future probably refinance like everyone else in 2020, 2021. And they have that 3% mortgage. So if you find that property that has a 3% mortgage or an FHA loan, you can go through your realtor for this, and you can actually contact Mike and I if you need realtors to help vet this and look for this. You can actually, an example, if you have a mortgage that has a $400,000 balance, the person that you're buying from has a $400,000 balance on their mortgage on an FHA loan. The purchase price is $500,000. Okay, you would have to put $100,000 down, 500,000 to 400,000, to get to the balance of where their loan is. You would have to qualify for the FHA loan, which is basic credit, income, down payment criteria, and you could conceivably take over that person's mortgage in your name at the 3% rate that they got in 2020, 2021. Sounds crazy, but it's true. It's only on FHA loans and VA loans, USDA loans, government-backed loans, and it has to be a purchase on an owner-occupied home. You can't do this as an investment property. This has to be a home that you're living in. So conceivably, if you're on this call right now and you have that 3% mortgage, whether it's a VA, FHA, or USDA loan, and you're looking to sell your home, you could, for an example, $500,000. What do you think? You could probably get more than $500,000 for your home.
Yeah, absolutely. If you're selling your house and you have one of these assumable mortgages, that's something that you want to put out there, because one of the big things now, people buying homes, they're like, 7% or whatever it is. If this thing comes with a 3%, provided you qualify, mortgage with it, that's something that's very, very, very appealing, of course.
So it's crazy. It's something that we're seeing a little bit more and more, and it's something that we'd love to help you out with. All right, no, it can't happen for everyone. You can't make the seller have an FHA loan, but if it's there, we can help you. We can guide you in the right direction. We can help you find that realtor that can help you find, or look into the seller of the property and see what type of loan they have to see if you're a possibility to get that type of loan.
I saw we had a question come in, which if you can put questions in the chat, someone just asking you to repeat how you did that calculation with the purchase price and the down payment,
Sure.
Everything like that.
So example, the purchase price of a home is, someone agrees to a $500,000 purchase price. You're the buyer, you're agreeing to buy this home for $500,000. The current homeowner has a $400,000 FHA loan currently at 3%. So you're buying it for $500,000, but you need to get down to that $400,000 loan amount. You have to put down $100,000 to get to that current seller's loan amount. All right, so 500 minus 400, that's $100,000 you need to put down. Then you'd have to qualify for, with credit and income, just like any other mortgage, for the FHA loan. If that goes, and if you do qualify and you have that $100,000 in this example for a down payment plus closing costs, then you can take over that person's mortgage. Another example, if the house is $400,000, that's the purchase price, and the current homeowner's mortgage is $350,000, you would have to put down $50,000 to get to that person's loan amount, plus the regular closing costs like a mortgage tax, title insurance, things like that, to get to that $350,000 loan amount, and you can take over that person's mortgage in your name.
All right, that's obviously it's a lot to digest just on this, but certainly reach out to us after this offline. We can have a conversation, email back and forth, things like that. Talk a little bit about making your offer stand out. How many people out there have been outbid on a house or went out house hunting, thought you found the home of your dreams 3 different times, but ended up losing your offer to somebody else? I'm sure everybody could raise their hand right now. With inventory this low, it happens all the time. People come in, they go above and beyond the purchase price. They'll do an all cash deal or a large down payment, little things like that. So if you don't have the luxury of paying, thousands of dollars more than what the seller's even asking, or you don't have, all that money sitting in the bank to go cash, how can you still make your offer stand out? All right. So your qualified commitment or forward commitment. All right. One of the biggest fears of a seller is that they get down, they go through the whole process with the buyer, and at the end of the day, they end up getting denied for a mortgage. A qualified commitment or forward commitment that we offer here at Fellowship Home Loans means that your file has been completely vetted by not only the loan officer, but the underwriter. The underwriter actually signs off on it, says they've reviewed credit, income, assets, all things there. And it's basically a mortgage commitment to based on the purchase price and down payment on a to be determined address. Or if you're trying to go into contract, we can do it for that particular house. You can waive certain contingencies. This is very, very important because a lot of times when purchase prices are going at the asking price or above and beyond, sellers get very concerned that when the appraiser goes out there, it's going to come in low and it's going to foil the deal at the end of the day. So they'll ask you to waive an appraisal contingency. It's totally fine. All right. As long as you still have the mortgage contingency in there, if you want to get out of the contract, we can still get you out because you can waive the appraisal contingency and other contingencies, but we can find another issue with it. So if the appraisal does come in low and you're like, I don't want to overpay for this house, well, now you'd have to put down more money, which maybe you don't have. So we can issue a denial on that and you get your earnest money deposit back. So there's a lot of different ways. Every situation is going to be unique here. So I was speaking in general terms right now, but just know that can make your offer stand out if you're willing to waive contingencies, but we would still have a way to get you out of that contract if you needed to get out. Have your Fellowship Home Loans loan officer contact your realtor. This is huge, especially a lot of our clients at Fellowship are people that we've done business with for years. We can call the realtor and let them know, hey, I've done business with this person forever. They have, I can get this commitment. I'm not even the slightest bit concerned. They have income that's very easy to underwrite, and you just give them that nice, warm, fuzzy feeling about everything going on. Down payment. All right. People usually have a certain amount of money they want to put down. Sometimes they're looking to go FHA, it's 3.5%. Maybe they want 10% down, 20%, 30%, whatever it is. Now, if you have, let's say you only want to put 10% down because you want to have X amount of money in the bank, because you want to, do some work to the house, you got to furnish the house, all of those different things, but you have verified assets on the offer letter, you could say that you're willing to put, or you have 20% down, 25%, 30% down, which is going to make the seller feel more comfortable. At the end of the day, if we have a mortgage commitment at 10% down, they're not going to care. The seller doesn't care if the money comes from your bank account or from the mortgage lender. As long as the check clears, they're not going to care. Trust me. So certain ways that we can, spruce up your offer there. Here's just a kind of an interesting thing that Brian and I put together with housing prices now. And this is a pretty remarkable chart that I'm going to show you guys here. And, as Brian said, something's got to give. So take a look at this. In 1995, the average home price, and we're speaking on a national level, all right? I know as Brian said before, in different areas, if you're in like the Northeast or something like that, things could be a little bit more expensive. But in any event, this is pretty interesting stuff. 1995, the average home price was $130,000. If you put 20% down, $26,000 down payment. The average mortgage rate that year was 7.86%. That would put your monthly payment at $753. The average income per household in 1995 was $29,000, again on a national level. And that would put that your mortgage payment was 31% of your monthly income. Okay, let's fast forward to 2019. The average price of a home, 260. That puts a down payment at 52,000. The average interest rate in 2019 was 4%. Principal and interest 993. Average household income 56,000. So your monthly payment was 21% of your monthly income. Now, what happened? COVID and everything else. 2023, the average purchase price of a house, 436,000. 20% down is 87,000. The average interest rate, this was as of last month, was 7.4%. That puts your principal and interest at $2,409. Income stayed steady at 56,000, which meant that you were spending nearly half of your paycheck on your mortgage payment before taxes and insurance. That's just principal and interest. That is insane.
Goes exactly to the big problems. Is the one that sticks out. Obviously, 21 to 49% is outrageous, but the income hasn't moved. Hasn't moved in 4 years, which normally, like, okay, it shouldn't move much in 4 years, but the rate's just astronomical, and the price.
Yeah. So something's going to have to give. There's going to be some type of market correction, but it's just another reason why to have another revenue stream. As Brian said, that passive income. Whether it's a fix and flip, which is one time, boom, make a nice little chunk of change on a house, or if you become a real estate investor and have multiple properties and have them all paying for themselves and a little bit left over for you each month, all the while that you're gaining equity in the house. Let's look at these numbers here, and certainly the numbers don't lie.
So we know we went through a lot of things pretty quickly there, but we know that everyone has a busy schedule. Everyone has a busy day. We could do more. We could talk about mortgages till we're blue in the face. It wouldn't be that fun for everyone. We could talk about reverse mortgages, the pros and cons of reverse mortgages. Who's it for? Is it for you? What does it actually do for you, the homeowner? We'd love to help you out on other aspects. We'd like to review your insurance policy, your homeowner's insurance policy. We work with many agents to see if you're paying too much, or if you covered not enough, or you have too much coverage. We also have mortgage protection insurance that we can help out with as well. This is in case when you or your spouse passes away, what's going to happen with that mortgage? How are you going to be protected, or how is your spouse and family going to be protected with that mortgage payment and that loan amount? We like to take a look at values in your area. We have some different type of programs where we can look up, hey, this is an idea where your house may be worth, what you can sell it for, where we think it could appraise for. We have no problem doing that for you as well. And we work with many realtors in your area. If you're looking all over the country, if you're looking to purchase or sell, we want to work with like-minded people that share your values, our values, and just kind of be in line on the same page. And also cleaning up credit. We can help with your credit, take a look at your credit report for you, put you in the best position to, hey, I need to refinance now, I need to refinance down the road. I want to purchase a home now, I want to purchase a home down the road. And we can also look at the credit report and look at the trends. Like Mike said, like the fear versus solution, the borrowing upon borrowing. Is it a ticking time bomb down the road, or are we in good shape? We're here for anything that you need. We'd like to have more of these that are maybe more specific to certain programs that we have. Our contact information is right there. Feel free to reach out via email, text, call, whatever you want. We're here for you, and we appreciate you guys logging on. And that's really
just a few things. Just to we any questions you guys have, as Brian said, email us, call us, text us, whatever it is. And just so you know, we're going to send a copy of this PowerPoint as well as recording of this to all of you guys via email. There's a lot of people that registered so they could get a copy of it that weren't able to log on at 12:30. Also, any comments, feedback that you guys have, one that we have for you, because we're at work right now doing work. You guys are taking time out of your day to be here with us. If you guys would prefer if we did these outside of work hours, I'd love to hear your feedback on that as well. So listen, thanks so much for joining us today. Please reach out to us with any questions that you guys have in any facet of our contact info there. And listen, we hope to hear from you guys all soon. All right. Thanks so much. Have a great rest of your day.
Take care.